to chapter 19, all about insurance. Where I'll talk about life insurance, car insurance, home insurance, renter's insurance. We all have to pay insurance. Fun, I know. So some types of insurance. Some strange things people have insured. Bruce Springsteen insured his voice for $5.7 million. Tom Jones, his chest hair, huh? The football player, Troy, his hair. He has some great hair, by the way. Mariah Carey, Tina Turner, and Brooke Shields all insured their legs. Gene Simmons, so he's the lead singer from Kiss, the band Kiss. So he's the one who sticks out his tongue a lot, so he insured his tongue. The world yo-yo champion insured his hands. The Riverdance and Lord of the Dance star, who does that dance where his legs kind of flail about, he insured his legs as well. And then the food critic insured his taste buds. Oh, a couple more also insured their vocal cords. Some strange things related to insurance. There is a zombie apocalypse insurance, which, I don't know, maybe you might need that. An insurance company covered a man's claim that a monkey stole his wallet while he was on vacation. So he claimed that and they covered it. A mom can also get multiple birth insurance in case she delivers 2 babies instead of 1. Maybe she's only expecting 1 and 2 come out. So thankfully maybe she had insurance and she's good. Some key terms you need to know. Insurance is just a form of protection against unexpected financial loss. So it's giving someone else the risk instead of taking it on yourself. A comprehensive policy is an insurance policy that protects the insured against several risks. The insured is basically you, the policyholder, that carries the insurance. The insurer is the insurance company, also known as the underwriter, that insures you. Policy is just your contract. Premium is the amount paid, typically every month. So your insurance premium is your monthly payment, basically. Face value is the max amount of insurance provided by the policy. The beneficiary, that's whoever gets the money. Typically this is used in life insurance, so you'll have to write down a beneficiary. So parents a lot of times will put their children down, which means their assets and money goes to their kids. So for life insurance, it's usually purchased for the purpose of providing income for a family upon the death or disability of the insured person. Financial planners have often suggested that your coverage is 7 to 10 times your annual income. So that means the face value. So if your income is $40,000, then 7 times that, $280,000 would be the face value of your policy. You'd want at least that much. Another way to determine it is to figure out the difference in the total expenses of a family and the amount of income the family would have after the death of the insured. So figure out how much income your family would need every year. Okay, so there are 3 main types of life insurance. There's term insurance, whole life, also known as ordinary life, and then universal life. Term insurance is for a specific set term. So it's a certain period of time, usually 5, 10, or 20 years, where they say, okay, it'll last for 5 years, for 10 years, for 20 years. At the end of the time period, though, the policy has no cash value and the insurance ends. So if you take out a 10-year term insurance, that means for those 10 years, if something happens to you, your beneficiaries will get the money, et cetera, et cetera. But at the end of the 10 years, the money just kind of goes away. So if the insured dies during the 10-year period, the beneficiary receives a face value. But if they're still living at the end of the 10-year period, the insurance ends. And like I said before, the policy has no cash value. It just kind of disappears. Now the advantage, so why would you want to use term insurance if the money just goes away after a set period of time. Well, it's usually the cheapest. So a lot of people will get that. And it's usually a good option to do a 20-year level term for families with young children, because that will take care of their children as they grow up, and then once they're grown up, maybe they won't need that money as much because they'll be on their own. So whole life insurance, there's a couple different kinds of whole life insurance, and insurance agents often like to sell you whole life insurance because they make a lot more money off of it than they do off of term, but it's not always the best option. So one type is, so the main type is permanent life insurance. The cost is higher in the first several years of your coverage, but the cost won't go up. For whole life, the insured pays premiums for his or her entire life, starting whenever they take out the policy. And when the person who takes out the insurance policy dies, the beneficiary receives a face value, just like in term. But here's the difference. If the policy is canceled, the insured is paid the cash value of the policy. So they get the amount back that was paid in so far. So it doesn't just go away like it did with term insurance. For universal life, it provides permanent insurance coverage with flexibility in the premium payment and death benefit options. The internal rate of return, so the interest rate, another way to think of it, can be higher because it moves with the prevailing interest rates of the market. So again, what I said before with the side note, insurance agents make a lot more money selling you that than they do selling term insurance. So just be cautious if that's, make sure you know what you want before you go in there. So some factors in determining what rate you pay for your, for your life insurance. The three main ones are whether or not you use tobacco and nicotine, so if you're a smoker or not. Your weight to height ratio, so they take into account that and your family health history to determine how healthy you are. They also may look at other things based on your occupation. So for example, your driving record and any dangerous vocation you have may play a part. So like if you're a pilot, you're putting yourself at risk more often than a teacher might be. Although I guess that's debatable too. Or like a hang glider or a skydiver, you're probably going to have a higher life insurance policy and premium than someone else who doesn't jump out of planes daily. Okay, so how to estimate your life insurance premiums. There is a table, so this is what it looks like. Table 19.1 in your book. You're going to locate the rate, and then you're going to divide your policy face value by 1,000, because if you look at the table, it's the life insurance premium rates per 1,000, so that's why you're dividing by 1,000. So you take the face value divided by 1,000 times the rate, and the rate is from the table. So, if you look at the table, we've got 10-year level term insurance, 20-year level term insurance. So these are both term insurance. We've got whole life insurance and universal life insurance. So you've got male and female for each category. We've got some ages. And this is right here, PREF, NT, and T. You'll see down at the bottom. PREF is a preferred insurance rate. It's hard to get those. NT is non-tobacco user, and T is tobacco user. So if you notice this little side note, typically less than 25% of people are eligible for the preferred rate. So most people are going to be NT or T. So let's estimate the annual premium for a life insurance policy with a preferred rate class and a face value of $100,000 for a 30-year-old male. So remember, to use this table, you're going to take the face value and divide by 1,000 to start. So the face value is $100,000. You're gonna divide that by 1,000. And, I don't know if you know the trick, but you just basically cancel out the zeros. So you get 100, and then that's gonna get multiplied by the face value. And the face value is gonna change based on if you're doing term, whole life, or universal life. So I'm sorry, did I say face value? The rate. And the rate is based off of the table. So, for a 10-year level term, it was a 30-year-old male. So 10-year level term, male, 30. So preferred rate class, right? So PREF. So that's going to be 0.87. So we're basically going to multiply the 100 times the 0.87 to give us $87. Okay, for the 20-year level term, it's still going to be 100, but now the number I'm going to multiply by, you look at the table, 20 years for a 30-year-old would be 1.12. So $112. And then and remember this is the annual premium, so the yearly premium. So yearly, if you take out a 20-year level term insurance, yearly you'll pay $112 for life insurance. Life insurance can be relatively inexpensive depending on what kind you get. So notice the term are pretty inexpensive because this is for the whole year. Whole life and universal life get a little more expensive. So for whole life, we'll still take this same example. I'm going to find them both while we're at it. Whole life for a 30-year-old preferred male is 10.86, and universal life for a 30-year-old male is 7.41. So the whole life is going to get multiplied by 10.86. So now it jumps up to $1,086 a year, which is a huge difference from $112 a year. And then universal life is a little less expensive, but still a lot more than term. So term is cheaper, but the downfall is that it expires once the term expires. Whole life and universal life are more expensive, but the money is in there for life. Okay, now let's say you want to make payments for periods less than 1 year. So instead of paying the premium annually, so at once a year, you want to pay monthly or you want to pay quarterly. So like for example, your annual premium is $1,086. Well, let's say you don't have $1,086 on you right now. So you want to break it down into monthly payments. That's fine, but you're typically going to pay a little bit more than you would expect because they're going to charge you for interest and they're going to try and get money out of you any way they can. So, if you look at this table, 19.192, this tells you if you would rather not make lump sum payments. So if you would rather make semi-annual payments, that would be twice a year. You would expect to pay 50% each time you pay, right? Pay half the beginning and then half in 6 months. Well, instead of 50%, they're going to charge you 51%. So they can make some money. Quarterly, so that would be paying 4 times a year. So you would expect to pay a fourth of the amount every time, right? So 25%. Well, they're going to charge you 26%. So they can make a little money. Monthly, 1/12, they're going to charge you 8.75%. So, estimate the premium for a $250,000 whole life policy on a 30-year-old female using a tobacco rate for semi-annually, quarterly, and monthly. So first thing we need to figure out is what their annual premium is going to be. That's where the table comes into play. So $250,000 whole life, tobacco user, 30-year-old female. All right, so $250,000 whole life. So whole life is right here. $250,000. It was a 30-year-old female, so female tobacco user. So 13.48 is the table number. Okay, so table number, we'll write this on the side, 13.48. Alright, so remember the formula for finding the premium is to take the face value, which is 250,000, and divide that by 1,000, and then multiply that by the table number, which was 13.48. And that gives us $3,370. So that's a pretty big chunk of money every year. So I could see why someone might not want to pay it all at once. So if we were just going to pay it right at the beginning of the year, that's what we would pay. But if we wanted to pay it semi-annually, if you look back at this table, semi-annually is 51% each payment. So I'm going to do 51% of the $3,370. And that just basically means I'm going to multiply them together. 0.51 times 3370, which is $1,718.70. Okay, for quarterly, I'm going to take this annual premium, and remember this table said 26%. So I'm going to multiply it by 0.26. That gives me $876.20. And then if I wanted to do it monthly, the percent on the table for monthly is 8.75%. So remember to convert these percents to decimals first. So instead of 8.75, it's going to be 0.0875. And when I multiply those, I get $294.88. All right, so that's what you would pay every month. All right, that's 19.1 is all about life insurance. 19.2 is about property insurance. So that could include renter's insurance, homeowner's insurance. I'm guessing most of you have renters or homeowner's insurance. If you live in an apartment, you have to have renter's insurance for most apartment complexes in order to even live there. Okay, so the way you figure out renter's insurance, so there's this table, 19.3. You're going to find the base annual premium using all the information from the table. Then you're going to add any extra options that you selected. And then to find the cost, the annual cost for these extra options, you're going to take your coverage desired, divide it by 100, and then multiply it by the rate. And then you'll add all these together. So let me show you what that looks like. So let's say Penyo has excellent credit and decides to buy renter's insurance with identity theft fraud protection and an additional $2,000 in computer equipment coverage. By the annual premium for a $20,000 policy with minimum liability protection using a $1,000 deductible. Okay, that's a lot of information, right? So first we need to figure out the base annual premium. So in our table, we've got a couple things. We've got a $20,000 policy limit or a $40,000 policy limit. And then we've got, for liability, we've got our deductibles of $500 or $1,000. Now deductible, what that means, that's how much you have to pay before insurance kind of kicks in. So if you have a $500 deductible, you have to pay up to $500 in damage, and then after that, insurance will start covering. $1,000 deductible means that you have to pay up to $1,000 before insurance company covers the rest. So if obviously you want a low deductible because that's less you have to pay out of pocket, but that means you're going to pay more monthly. The lower your deductible, the higher your monthly payment is. That's the trade-off. Okay, so then we have, this represents the type of credit. So if you look down here, good is good credit. Occasional is occasional payments past 30 days. So every now and then you pay off something a little late. And then bad is bad credit. So maybe you went through a bankruptcy at some point, or you have some bills that went to collection agencies, then you'd be considered to have bad credit. Okay, so Pino had excellent credit, so she has good credits. She wants a $20,000 policy with minimum liability and $1,000 deductible. Okay, so $20,000 policy limit, that's this one. Minimal deductible, so $500. Or sorry, minimum liability, did it say? Yeah, minimum liability. So, sorry, I apologize for that. Minimum liability, these are the liabilities, 300,000, 500,000, and 1 million. So she wants the lowest one. And she wanted a $1,000 deductible, so this one. And she has excellent credit. So we're going to use the number 126. So this means if she doesn't add any other type of protection, her annual premium is $126. So that means every year she'll pay $126 for renter's insurance. And then if she wants to divide that by 12, she can, although it's going to be a little more than that because of interest. So that's her base, $126. However, she wants a few extra things. So this is 19.3. This is where the next table comes into play. This is also in your book. So you can get some extra coverage on identity theft and fraud, sewer protection, maybe you have some jewelry or camera, computer equipment, all sorts of different things you can get covered. So let's see what she wanted. She wanted identity theft and fraud protection. So let's write what we've got here. We've got our base of $126. Identity theft and fraud protection is $20 a year. So in addition to this $126 every year, she's going to also pay $20. All right, and then she also wants $2,000 computer equipment coverage. Okay, so computer equipment coverage, so she wants $2,000 covered, right? So this is 95 cents for every $100 a year. So I have $2,000. So I need to divide the 2,000 by 100 because it's for every $100. So that means 20 times 95 cents because it's 95 cents for every $100. And I have 20 hundreds of dollars if I want 2,000. So I'm going to multiply the 0.95 times the 20. To get the amount of coverage for a computer. And then that's all she wants. So base is 126, identity theft is 20, and then for the additional computer coverage, like I said before, you divide by 100 and then multiply by 95 cents. So every year she's also going to be paying $19 for her computer coverage. So now I'm going to add all those together to figure out her annual premium, and it's $165 if you add those three together. And then she can decide if she wants to pay it all now or monthly or quarterly, but $165 per year for her renter's insurance. Okay, homeowner's insurance is very similar. So there's another table for that, and it's based on, so it's the annual premium rates for every $100 of the face value. So you have a couple different things on here. You've got a regular frame home, a masonry home, and this is just an example. It's going to be different depending on where you live, but here's, let's say you live in zone 1, zone 2, or of a regular home, and then you got zone 1 and zone 2 of a masonry home. And again, they look at your credit, good, occasional, and bad for each one of these. And then your deductible is right here, either 1,000 or 1,500. All right, so you're going to find the base annual premium, and then add the cost for any options. You're going to divide it by 100, and then times the rate, and then same thing with extended coverage. So you'll add them all together, just like we did for renters. So let's start off with the base annual premium. David and his wife need to insure their masonry home located in Zone 1 for $150,000 using a $1,000 deductible. Okay, so let's start there. So we said masonry home, so that's this right here. And then Zone 1, right? Oops, wrong way. So Zone 1. And, okay, sorry, I forgot there's one more piece of information. Find the annual premium if they make occasional payments past 30 days. So that would be the OCC. And the deductible was a $1,000 deductible. So that's this one. So the number from the table that we're going to use is 0.36. All right, so that's 0.36 of the face value. So notice that this was for every $100 of face value. So the face value was $150,000 if you look right here. This is the face value. It's usually the biggest number. So that's going to need to be divided by 100 to start. And then we'll multiply it by the rate from the table, which is the 0.36. So it's 150,000 divided by 100 times the 0.36. So the base annual premium, so every year it's going to be $540 if they don't want anything else. And typically homeowners insurance will be more expensive than renters insurance. All right, so now they also want to add identity theft and fraud protection, sewer and some pump backup protection, and then also an additional $30,000 of protection for jewelry, watches, and furs. So we're going to use that same table that we used for renters insurance to get all that information. They wanted identity theft, which is $20 a year. They wanted the sewer pump backup stuff, which is $75 a year. And then these ones right here are all based on their per $100, right? So they just wanted the jewelry, watches, and furs, which is 85 cents for every $100 a year. Okay, so we've got the identity theft, which was $20. The sewer backup, which was $75. And then remember, it's for every $100, so they wanted to insure their jewelry for $3,000. So you're going to divide that by 100, and then multiply by the table value, which was 85 cents. And you get $25.50 for the jewelry. So then I have to add all those together, which gives me, I don't know if you can see that very well, $660.50 is their annual premium. And then they can decide from there if they want to do monthly or quarterly. All right, so that concludes the renters and homeowners insurance. So let's look at vehicle insurance. So most of you, I'm sure, have some sort of vehicle insurance if you drive. So there's liability insurance, which is kind of like the basic. It's protection for the owner of a vehicle if an accident causes personal injury or property damage to others and is the fault of the driver of the insured vehicle. So by law, you have to have liability at least. Comprehensive is protection for the owner of the vehicle for damage typically caused by a non-accident incident. So it's not It's not when two vehicles hit each other. It's for all those other things like acts of nature. So like fire, water, theft, vandalism. So things outside of a car crash. And then there's collision, which is the car crash part of it. So that's protection for the owner for damages, both personal and property, from an accident that is your fault. Okay, there's uninsured or underinsured motorist coverage. So that's in case you hit someone who's not insured or doesn't have enough insurance to cover it. Then you'll have enough insurance to cover you. So that's a type of insurance you can take out. Medical expenses. So that provides for payment of 100% of any medical bills up to the coverage limit arising from a collision, covering the driver and each passenger. Territory, these are some keywords. Territory is the primary location where the vehicle is driven. So that's your territory. Okay, liability limits. So that's the maximum amount an insurance company will pay for a single accident based on coverage selected by the insured. So you may have seen these numbers if you've ever looked up insurance. They'll have some slashes. So the first number represents the max for bodily injury per person. So that's in thousands of dollars. So they'll cover a max of $50,000 for bodily injury for each person involved. The $100,000 is the max for all bodily injuries combined. So they'll pay $50,000 per person, but only up to $100,000. So if two people take up the $50,000, then there's not enough for the third person, and you'll have to pay that part. And then the last number is the maximum property damage, so they'll pay up to $50,000 in property damage if you have this type of liability. And these numbers will change depending on what kind of coverage you get. Okay, bodily injury is just personal injury. Property damage is damage to the property of others, their vehicle. Deductible, so we talked about that already, but that's the amount an insured person pays for damages to the insured vehicle before the insurance company pays for damages in excess of the deductible amount. So if you have $1,000 deductible and you get into a crash that costs $2,000, you pay the $1,000, and then the rest of it is either covered by your insurance, or maybe they pay 80%, you pay 20%, depending on what kind of coverage you have. But you have to first pay the deductible before insurance will start to kick in. The book value is the value of a particular year, make, and model of a vehicle published for car dealers and insurance companies. So you may have heard of the Kelley Blue Book, that type of thing. If the damages resulting from an accident exceed the book value, then they say that your car is totaled, and the insurance company will only pay the book value. So if you live in Arizona, I found some information about that. Arizona requires drivers to have car insurance that meets or exceeds these minimum levels. So you have to have at least $15,000 per person for bodily injury and $30,000 per accident. You can obviously have more, but you at least have to have this coverage. You also have to have property damage, a minimum of $10,000. You have to have uninsured and underinsured motorist bodily injury coverage, minimum of $15,000 per person, $30,000 per accident, and then same thing here. Here are some suggested deductibles and limits. So this, if you are looking for insurance, you can use this as a reference. This is just some suggested deductibles to look into if you are clueless. Some factors affecting the cost of your insurance. So where you drive will affect it. The total distance you drive every year, because obviously if you're on the road more, the probability of you getting in an accident is higher. The distance you travel to work. The types of use, so is it for business, is it just for personal use? Your academic record, so if you're, you are students, if you're a student, you're all students. If you have a really good academic record, there are many insurance companies that will give you a discount for having good grades. Also, your driving record goes into your premium rate. So if you have a clean driver's record, you're going to have a lower premium. So just some interesting information. Who pays the most in which state? Michigan actually pays the most for auto insurance. North Carolina pays the least. Here in Arizona, we're number 19. If you want to look at what cars are stolen more often than others, you can look at this site. A couple other pieces of information I found to be interesting. A 20-year-old single man pays 49% more for car insurance than a 25-year-old single man. So once you turn 25, your insurance goes down. Something to look forward to, huh? If you're not there already. He will also pay 23% more than a 20-year-old single woman. So men do typically, younger men at least, tend to pay more in insurance than women, just based on information about accidents and things like that. Whether it's fair or not, it's just based on numbers. So a 20-year-old single woman will pay 28% more than a woman the same age who is married. Don't know why, but that tends to be the case. And then also monthly premiums stabilize around age 30 and then start to decrease for men and women until they turn 60. And then after that it starts to go up again. Alright, so we'll have some more tables for this. So you're basically going to add all this information together. So I'll show you. To figure out your annual premium, you'll take all of your premiums and add them. And then the only thing you're going to subtract is any discounts. So like a good student discount, things like that. Everything else gets added together. So you'll use tables 19.5 and 19.6. This is table 19.5. This is table 19.6. So for 19.5, again, we have our territories, good, occasional, and bad credit. And then here are your liability limits. And here's a reference as to what they represent. Each slash. Okay, so find the annual premium for an automobile liability insurance policy to which the insured driver lives in Territory 1. Okay. They have good credit. Okay. Good credit. And wishes to have 50, 150 coverage. Okay. So that's this one. You want the lowest coverage. So that would be $385. So that's the annual premium. So what they pay yearly. Is that $385? Okay. So $385 is what they're going to pay as a base amount. Okay, now the automobile is a 3-year-old model class 2 vehicle with a $250 comprehensive and a $500 collision deductible. Okay, so this one was just for liability. The next table is for comprehensive and collision. Okay, so we're Territory 1. So notice now this table, here's Territory 1, here's Territory 2. So we're going to have one for comprehensive and one for collision. So for comprehensive, they wanted $250. So that's here. They had good credit still. 3-year-old model class 2 vehicle. So class 2, age 2 to 3. Go over to good credit, right? And it's $301. So for their comprehensive, it's $301. And for collision, they want a $500 deductible. So for collision, we got a $500 deductible, good credit, still class 2, 3 years old, so $417. Okay, so we're going to add all three of these things together. So we've got our $385 plus our 301, plus our 417. But then he's been accident-free for 3 years. Wow, so great. So that's where there's another chart right here that has discounts and surcharges. So discounts are going to be subtracted, surcharges are going to be added. So there's a good student discount, accident-free for 3 years is 5%. So if we add all those things together that I said before, we get $1,103. Okay, but then I'm going to take off 5% because he was accident free. So I need to figure out 5% of that. That's $55.15. So that's getting subtracted from my $1,103. And that gives me $1,047.85. Is my total annual premium. All right. And that is it for insurance. So if you don't have some, go get some. And have a great day.